Welcome back, everyone. We're going to continue with creating your personal financial statements, the first one of which is statement of cash flows. Here are the layout for the statement of cash flows. The first group includes your cash inflows. So that will be your gross income minus any deduction that gives you your take-home pay. When you have, and then you have your other income, which include either gifts, scholarships, and so forth, as well as investment income, which may include interest and dividend. When you add up your take-home pay, gift, investment income, that gives you your total cash inflows. The next group includes your cash outflows. There are two types. Remember, the first one are essential expenses. Here are the categories that this particular example uses. Remember once again that these categories you choose on your own. When you add up all your categories under essential, you get your total essential expenses. The second group is optional expenses. Again, you can decide how you want to organize this. And when you add up all the categories under the optional expenses, these are your total optional expenses. Adding your total essential expenses to your total optional expenses gives you your total cash outflow. That's your second group. The last group in the statement of cash flow is the cash surplus. Cash surplus or deficit is computed as cash inflow minus cash outflow. So we take our total cash inflow that you computed in the first group minus the total cash outflow you computed in the second group, and you get if you get a positive number, meaning your inflow is greater than your outflow, you get a surplus. Otherwise, you have a deficit. Here's a review of the formulas that I talked about. Your take-home pay is gross income minus deduction, and then your total cash inflows are your take-home pay plus gifts and other income and investment income. You may want to pause this video for a minute and write this down. This information is also included in your textbook. Next, we're going to look at the statement of net worth. Another name for statement of net worth is your personal balance sheet, and you sometimes also call asset and liabilities. The statement of net worth basically lists all the assets, things that you own, as well as your liabilities or debts. That's money you owe, and the difference between the two is called your net worth. And sometimes that's also called equity. So also hear this as the statement of equity. So the first step is to list everything that you own. So these are your assets. We'll order them in order of liquidity. Liquidity means how fast you can convert something into cash. So the most liquid assets are cash, money in your checking account, savings account. So these are money in your bank. The next type of assets are investment assets. So this includes stocks, bonds, your retirement account. And then the last one is real assets. Real assets are your house or your car. So to sell a house or a car will take more time than selling a stock. And of course, cash in your pocket or money in your checking account is money that you can use right away. So this is the order of liquidity. Then the last type is, in addition to real estate, are other personal possessions, your car, your clothes, your phone, your computer. Those are not worth much if you need to sell them for cash. So that's step one. Step two is determine everything that you owe. So these are called your liabilities or your debts. Current liabilities are debt that you must pay within 1 year. The most common examples for those are credit card balance, which you need to pay within each month. Consumer credits, this include anything such as buy now, pay later, and so forth. And then there are longer term liabilities. These are debts that you have more than 1 year to repay. For example, car loan, student loan, mortgages. That's step two. The last step, step three, is to compute your net worth or your equity. Your net worth or your equity is equal to your total assets minus your total liabilities. So what affects your net worth? First, if you make more money, you'll increase your net worth. So your cash surplus can be used to either increase your saving or pay off liabilities, both of which will increase your net worth. When you don't have enough money, when you have cash deficit, you're either using up your savings or you have to borrow money, and that will reduce your net worth. In addition to that, your net worth can go up or down based on the value of your investment. So if you own stocks or you own mutual funds in your retirement account and the stock market goes up, your net worth goes up. The same thing if you own a house, the house value goes up, your net worth goes up. And vice versa, when the stock market or the housing market goes down, your net worth will also go down. Something that's very important is that your net worth is not money that you can spend, but it's just an indication of where you are on a particular given day. If your net worth goes up because housing market prices has gone up, you cannot simply sell your house and use that money because you still need a place to stay. Oftentimes, you may encounter a negative net worth. That just means that you owe more than you own. And this is not uncommon for young people, especially those of us who have student loans and not a whole lot of assets. Let's take a look at an example to see how we can use the statement of cash flow and the statement of net worth to help us with financial planning. This is the same example that is in the textbook. I encourage you to pause the video, review the textbook so you get a better understanding of what we are talking about here. Maya and Isis is a couple in their early 30s. They're married with no children. They have good occupation, and their income, combined household income, so that's both of their income, is $126,000. This is their gross income. So here are their assets. They have a house, a car, and these are their liabilities. They have a mortgage, car loan, and student loans. They have some financial goals. Their short-term goal is to rebuild the emergency fund because they just bought a house and they use up a lot of their savings towards the down payment. Their intermediate goal is to renovate the kitchen, and then their long-term goal is to retire. How do we use the financial statements that we created to help us evaluate our current financial situation? Remember, the ultimate goal is to find out where we are, and then we can create a roadmap to take us where we want to go. When we look at spending, there are two ways to look at spending. One way is to look at spending as a percentage of income. If you compute it as a percentage of take-home pay, you take each spending category's total divided by the take-home pay, and that will give you a percentage. And this is a useful way to look at it. For example, housing costs. If you find out that rent or housing costs divided by your take-home pay is 50%, that means half of your take-home pay goes towards housing. And that tells you how important that category is. Another way to look at spending is to compute it as a percentage of your total spending. All that does is change the denominator to dividing spending category subtotal by your total spending. That tells you how much your spending goes towards a particular category. Both are useful information, and it depends on what is more relevant to you. For most of us, as a percentage of income usually makes more sense because we are concerned about how much money we are taking home and where that money is going. Let's take a look at Maya's and Isis example. For Maya's and Isis, their take-home pay is $94,500. If you look at each category, as a percentage of take-home pay, you divide $31,695 for housing by $94,500, you get 34%. I encourage you to pause the video and do your own calculation to check each category so that you understand how this percentage is derived. The same thing, student loan repayment is $3,600. You take $3,600 divided by 5,000, you get 4% or 0.04, which is 4%. we see that for essential expenses, housing and food are the two largest categories for Maya and ISIS. And that is not surprising. For most of us, we'll probably find that housing and food are our largest expenses. Their total essential expenses represent 71% of their take-home pay. So that means they have 29% of their income that they can spend as they wish. And if you look at this, it looks like their largest expenditure is leisure or entertainment. That's 16% of their take-home pay. Eating out is 7%. And they basically spend most of their money. If you look at their cash surplus, their total cash outflow is $94,290. Their take-home pay is $94,500. So over the year, they have for the entire year, they have $211 in surplus. So it's virtually zero. They basically spend all the money that they take home. So you can see in our example, for Maya and ISIS, their biggest expenses are housing, leisure, food, and grocery, and then eating out. You can also use your financial statement to help you identify some of your short-term goals. For example, emergency fund is an important short-term goal or an important part of your financial plan. A rule of thumb is to have 3 to 6 months of essential expenses in either savings or money market account. We'll talk about what money market account is in a later chapter. Essentially, what this means is that we want to have 3 to 6 months of essential expenses in readily accessible means. For Maya and ISIS, remember we computed the total essential expense is $66,971. If you divide this by 12, you get $5,581 per month. Again, pause the video to check that you see where these numbers come from. So divide 66,971 by 12 per year, that gives you $5,581 per month. So if we multiply this by 3, so 3 to 6 months, 3 times $5,500 is around $17,000. And if you multiply this by 6, it's about $34,000. So for Maya and ISIS, they should aim for an emergency fund somewhere between $17,000 and $34,000. That is one way you can use your financial statements that you created to help you determine how much emergency fund you should have on hand. Another very useful metric that you can compute based on your financial statements is the debt to income ratio or DTI ratio. The DTI ratio is something that lenders look at very carefully when they evaluate your loans. It determines how much they're willing to loan you as well as the interest rate they may want to charge you. The debt to income ratio is computed as your total loan payment, so including rent, divided by your gross monthly income. Your gross monthly income is the money before any deduction. For our case, for Maya and ISIS, their total monthly loan payment includes their mortgage, their auto loan, and their student loan. So you can go back to the example to see these numbers. So altogether is $3,427. Their monthly gross income is $10,500. So when we divide 3,427 by 10,500, we got 0.33, and that's 33%. This is their DTI ratio. What does this number mean? Is 33% good or bad? Well, a DTI ratio of less than 30 or 35% is usually considered good. So the DTI ratio for Maya and ISIS is within the acceptable range. It can be better, it can be lower, but 33% is okay.
If you're looking into buying a house.
We saw 2 examples of how you can use your financial statements to help you identify important things in your financial plan. At the beginning of this chapter, we said that one of the ways that you can achieve your goal, or the first step to achieving your goal, is to know where we are. So we need to compare where we are today, so compare our current financial situation to where we want to go, which is our financial goal. Let's use Maya and ISIS as an example again. Remember that their short-term goal is to have emergency fund, to rebuild the emergency fund. Based on their essential expenses, we determined that between 3 to 6 months, their emergency fund should be somewhere between $17,000 to $34,000. Maya and ISIS decided somewhere in between is they want to have an emergency fund of $25,000. We need to take a look at where they are today. Here is the personal balance sheet or the personal statement of net worth for Maya and ISIS. They have in their checking account of $200, their money market account is $800, so altogether they have $1,000 in cash. So this is where they want to go. They want to have $25,000. This is where they are today. They only have $1,000. So the action they need to accomplish their short-term goal is to save $24,000 in the next 12 months. So this is their short-term goal. Their intermediate goal is to renovate their kitchen. This thing is going to cost $15,000. Currently, they have a mutual fund balance of $5,200. That means that they need another $10,000 over the next 5 years. Their long-term goal is to retire at age 70. Based on their estimate, it is determined that they need to save about 10 to 15% of their gross income. This is a general guideline for most people, to save 10 to 15% of your gross income so you can have a target retirement age of somewhere between 65 and 70 years old. Their current retirement balance, so IRA and 401k, again, we'll explain those later on in the retirement chapter. These are their retirement accounts. They have $14,500 total. Remember last year, Maya and ISIS spent almost all their take-home pay. So they were not contributing to any retirement account. To accomplish their goal to retire at age 70, they need to start contributing 15% of their gross income because they have not been contributing in the past. To achieve this goal, they will have to make some significant changes to their spending habits. You'll get a chance to apply the tools that you just learned, how to create a financial statement, including a statement of cash flow and the statement of net worth, and to your own specific situation as your personal financial plan, as well as in a case study. This is the first part, is to do a case study. And here is the information for the case study. You have the option to download a spreadsheet template, and you may need to adjust the categories so that it fit into the template, or you can create your own spreadsheet. Either way is acceptable. The first part of the case is to create a statement of net worth and also create a statement of cash flow. And remember that these are all yearly numbers. You'll need to convert that to monthly numbers. If you download the template, you'll look like this. You only need to fill in the purple highlighted cell. The formulas are already created for you. You can also download the template, look at the formula, and create your own as well. If you download the template, all you have to do is enter the annual total numbers here, and the template will automatically divide that number by 12 to give you the monthly total. In addition to the case study, you'll also create a set of personal statement of net worth as well as personal cash flow statement using your own numbers. If you have any questions about these assignments, please feel free to reach out to me. Good luck! I'll see you in the next video as we continue on how to do budgeting. See you soon.